Hello everyone, I'm Dr. Stock, and in this video we're talking about that frustrating situation that is OPEC cutting oil supply. Now, if you were into some of the energy stocks, you definitely rode that ride up yesterday in the markets, and well, congratulations for that one. For those of us who are on inflation watch, oh my goodness, is this just such a headache, such a problem. All right, so let's talk about this oil thing. So right here, I have this from Reuters. Why is OPEC cutting oil output? And basically, it comes down to the price per barrel, not wanting it to drop down so low. So by having that cut, we see a $5 increase in price per barrel up to $85 per barrel. So really, we think that Saudi Arabia has this spurned on. So what they're planning to do is cut about a little over 1 million barrels per day in production. And one of the reasons that was thought about happening was, if I find it in here, now all the way at the end of this article, you'll see that it says the United States, which released most stocks, meaning the oil reserve, said it would buy back some in oil in 2023, but later it was ruled out. And we get JP Morgan, Goldman Sachs, saying that the decision to not buy back the oil for reserves might have contributed to the move to cut output. And well, that could most definitely happen if OPEC is seeking to maintain the prices of oil per barrel in order to keep the market afloat by cutting production. So basically, here's what's happening. If we think about Jerome Powell, he said that by raising rates, what they could do is they could control the demand side. They didn't have any control over supply side when it came to any sorts of goods or services that are in the United States for controlling inflation. So by the Fed increasing rates, and I'm coming back to oil with this, I promise, Fed increasing rates, what they could do is squeeze down that demand side, even though they couldn't directly affect the supply side. Well, for OPEC, it's different than that. What they can do is they can squeeze down the supply side, which then increases the demand side, which then increases the prices. Now, the problem with increasing demand for oil, for crude oil, is that, well, we are fossil fuel dependent, and well, it impacts prices throughout the economy for all sorts of goods and services. And so that's a problem, and it can keep inflation running hotter for longer for us. And what does that mean? It translates back to the Fed and possibly keeps them from pausing as soon as we would expect. Well, I don't know. I guess it depends on what you mean by expect. Are we looking at the bond market to see what they have to say, like the CME FedWatch tool that says the Fed will likely pause soon and pivot very soon to reducing rates? So we're going to have to see that. So let's take a look at the FedWatch tool. So here we go. And I'll make sure that this is a brand new refresh for you when we look at the CME FedWatch tool. And as of right now, there's a 56% chance of a 25 basis point hike coming for us at the May meeting. And so that's on May 3rd, and only a 43% chance that they're going to pause. And if we go out to the June meeting, that would follow that. There we go. Then we're getting right now priced in a pause as soon as June. Let's go out to July, and by July, we're seeing a cut priced in there. So right now, I would say that we are seeing an impact with the CME FedWatch tool, with the possible supply cut that could be happening with oil, and then increasing demand, possibly increasing inflation. We see that the Fed might have to end up being more aggressive with their rate hikes, which with that, it makes borrowing just so much more expensive, and it can mess with the bond market. So it can cause all sorts of trouble, and that's why we saw some softness in the markets today. Now, this could continue to play out, and we could see possibly if there's enough pullback from the consumer, because the consumer, it makes up 70% of the GDP, and that's important to keep in mind. 2 consecutive quarters of GDP contraction is what makes a recession for us. And please don't forget about Q1 earnings coming up, and also student loan moratorium also coming to an end in Q2. That means Q3, Q4. That means student loans are back in full swing, which can also make things a little bit more difficult for the consumer. So this oil thing, it really is tangled up with the rest of the economy, and that's why it impacts the markets the way that it did. And when you look at some of the companies, such as Apple, seeing a huge inflow today, I think that is part of that fleet of safety that we see. We also saw that flight to energy stocks in this instance for the markets today as well. So Chevron had a great day. If you're a follower of Stock Moe, Novus Energy was one that did really well. ExxonMobil, I believe, also did pretty well today. So the energy stocks were definitely one of those places that you could look to see that happening, one of those sectors that really benefited from this move. So let's just take a quick look at the markets today and we'll see where they're positioned and where they could possibly go in the near future. So what we're looking at here is the SPY, and I'll zoom in a little bit more on this more recent trend that we have. And it looks once again that we find ourselves in a channel, although a little bit differently possibly than we were in before. And we'll see how long it holds out for us. So off this peak here, there we go. And it'd be nice if we get another touch out there. As a matter of fact, if we get a touch out this way, that would put us pretty much even with the previous high that we have here. Now, we're going to have to see if the markets can hold out for something like that. When we look at the RSI, we are getting close to that overbought territory. With this most recent run that we've had, that is a lot of up with no real down in between. So we'll see if the markets can get that frothy. We do have these horizontals to pay attention to. It is possible that we peak out 413, maybe up to 415, 416. That could definitely happen for us. Now, as for the bottom line for this, there we go. Try and make it somewhat parallel based on what we have here. And you could see possibly holding on even more solidly to that 200-day simple moving average. If we do come back down, now we do have the 50-day up here to bounce back off of. They're certainly not the first lines of defense, although they can be pretty heavy support for us. As a matter of fact, even 406, plus we have the psychological support right at about 400 itself. So that's definitely something to watch out for as well. So in the near term, as long as there's no really big news, I don't think that we get moved in any major way downward from here. I do think that the bulls need a little bit of time to rest and recover before let the bears have their own little picnic or something before the bulls jump back in. And it is possible that we do trade for a little while here. I am, as I said before, leery about Q1 earnings and what that has to say for us, especially in light of this oil news that we get and we start to digest the economic impacts of it. So credit tightening, there's speculation over just how much we're going to get if banking fears have subsided, if the whole banking sector problem has cleared up for us. The oil supply crunch is going to be inflationary for us as well, which means that the Fed has to be a little bit more aggressive. And I've already gone over that. So let me just get to the Qs here. There we are. And the Qs, I mean, they're looking pretty well from where we're at. Now, they did close red yesterday, and we'll see where they go today in the markets when we look at this thing. So it is possible that we do reach this previous peak that we have here in the near term. So from where we sit right now, that's about 4% up. So that would be really good news in the markets from where we're at. This oil thing could cause us to stumble and have a little bit of trouble at this current area that we're at right now, right at about $320 per share. If we do come up to that 330, 332, as I have it right now, that is an area where we could find significant resistance and really have to try and break over that peak. And I don't know that we're in that position with all the talk of recession that we have to keep on putting in high after high without having a little bit of time to rest in between. So it is possible that we do come back down off of this. Maybe we come back and retest the 50-day in the near term before bouncing off of that. Maybe we get good news from the banks that it's a really good outlook, a really strong 2023. That would be wonderful to hear for the bullish positions that I have, for the short hedge position that I have. That's just in case the market goes like I expect it will towards recession and we have equities selling off and the markets come down. I have SQQQ and I have SPXU as my short hedges. So against those two areas of the market. And if we reach this area up here, especially in a very rampant overbought sort of way, going well up above 70 on the RSI, that would be a time that I might even go a little bit more aggressive into those plays just to take advantage of some short-term pullbacks in the price. So that's what I have for you guys today in this video. If you like my commentary and you would like to hear more of it, check out that link in the description for the Patreon. Click sign up, come join me and my community members that are over there and get access to my Patreon exclusives, including that Tesla earnings projection. Tesla earnings do come out on April the 19th. I have my preliminary projections ready. I have a more detailed one in light of deliveries coming out very soon for the Patreon in the next day or two. That'll be up and ready to go. Come on over. We'd absolutely love to have you over there as a member of the community. Finally, click that like button, hit the subscribe button to subscribe my channel and ring that notification bell to see any time that my videos come out. I am Dr. Stock, Doctor of Education. We'll see you in the next video.